Good day, everyone. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. Our focus this week is on simple guide to Nigeria's new capital gains tax CGT rules, how it affects your portfolio and how to win. This week we build on our recent episode about revamped capital gains tax CGT, highlighting the latest clarifications provided by the chairman of the Tax Reform Committee. If you haven't listened to the previous episode, it offers a comprehensive breakdown of the new CGT framework. Today's update focuses specifically on how these rules apply to stock market investors. Capital gains tax is simply the tax you pay on the profit made when you sell an asset for more than it originally cost, whether it's a plot of land, a stock you've held for years, or a rental property that has appreciated in value. With the CGT overhaul beginning January 1st, 2026, just weeks away, investors need clear, actionable insights. This guide moves from immediate preparation to exemption, strategic tax shields, long-term planning, and compliance. Here are 7 things every investor should know with relatable examples. 1. Your previous gains are safe. Cost-based resets on December 31st, 2025. What this means: any profit you made before 2026 will not be taxed. The government will reset your cost based on the market value on December 31st, 2025, or your original cost, whichever is higher. This protects long-term investors from paying tax on old gains. For instance, if you bought GT Bank shares at 25 Naira in 2020, and the price on December 31st, 2025 is 100 Naira, your new cost base for tax becomes 100 Naira, not 25 Naira. If you sell in 2026 at 150 Naira, you will only be taxed on the 50 Naira gain, which is 150 Naira minus 100 Naira. Your old 75 Naira gain is protected forever. Why this matters? It's a relief for those who bought years ago. No retroactive taxes on old profits. 2. Small and medium investors get relief, but only if they stay within the limits. What this means: you are exempt from CGT only if both conditions are met within a 12-month period. Your total sales proceeds are below 150 million Naira, and your total gain is below 10 million Naira. If you cross either of these limits, whether it is the amount you sold or the profit you made, your transactions become taxable. However, any portion of the proceeds you invest into Nigerian company shares within 12 months remains tax-free, even if you exceed the threshold. For instance, A. You sell shares worth 120 million Naira and your gain is 8 million Naira. No CGT, both conditions met. B. You sell 200 million Naira worth of shares, but profits is only 6 million Naira. Tax applies because you crossed the 150 million Naira sale threshold. C. You sell 100 million Naira worth of shares and make 15 million Naira gain. Tax applies because your gain exceeds 10 million Naira. But if you reinvest the proceeds or a portion of it within 12 months, the reinvested amount is exempt from CGT even if you crossed the thresholds. Why this matters? Most retail investors fall into this category. You may not need to worry about CGT at all. 3. Institutional and startup investors are fully exempt. Some investors never pay CGT under the new rules. This includes 1. Pension fund administrators, PFAs. 2. Real estate investment trusts. 3. Non-governmental organizations, NGOs. 4. Venture capital firms and accelerators. 5. Investors in approved Nigerian startups. 6. Nigerians who repatriate foreign investment gains through official banks. Example: a VC firm invests in a Nigerian fintech and exits with 500 million Naira gain. They pay 0% CGT. A pension fund sells shares worth billions. They also pay 0% CGT. For individuals, if you sell your US stocks and bring the money back through CBN authorized channels, the gain is fully exempt. Why this matters? This encourages long-term investment in startups and boosts foreign investment flow into Nigeria. 4. You can now deduct losses, FX losses, and fees. Under the old rules, you were taxed on your gains without subtracting losses or expenses. Now, you can reduce your taxable amounts by deducting realized capital losses on share disposals, brokerage and regulatory fees, margin interest, FX losses proved to be linked to the investment. For example, Chinedu invests 100 million Naira, sells half at a 20 million Naira loss, and sells the other half at a 30 million Naira gain. Brokerage and FX fees equals 2 million Naira. The new calculation: gain is 30 million Naira, loss is 20 million Naira, fees 2 million naira equals 8 million naira taxable gain. Without deductions, he would have been taxed on 30 million naira. Now only 8 million is taxed. Why this matters? Active traders can manage tax more efficiently, especially in volatile markets. 5. Reinvest your profits within 12 months equals 0 CGT. This is the biggest opportunity for smart investors. If you sell shares and reinvest the total proceeds into another Nigerian company's shares within 12 months, you get to pay 0 CGT no matter how big the gain is. Example, you sell shares for 200 million naira and make 50 million naira gain. Your potential CGT is taxed at 30% equals 50 million naira. But if you reinvest at 200 million naira into another Nigerian stock within a year, your tax becomes 0, meaning you walk away freely with the gains untaxed. Why this matters? This encourages continuous investing and rewards long-term participation in the Nigerian market. 6. Long-term investors benefit more than short-term traders. The new system favors A. Those who buy and hold, B. Those who reinvest, C. Those with consistent investment habits, D. Short-term traders, frequent flippers, lose more reliefs and may pay more tax. Example, Ifoma in the 30% bracket sells shares for 100 million naira, but she reinvests 80 million naira into new opportunities. Only the remaining 20 million naira is taxed at her income tax rate, a huge saving. Meanwhile, a short-term trader who doesn't reinvest pays the full rate. Why this matters? Long-term thinking now has direct tax advantages. 7. Filing CGT is now part of normal investing. Deadlines, individuals, March 31st every year. Companies, 6 months after financial year end. Non-residents, upon disposal of shares except where reinvestment within the same year is expected. Brokers or exchanges may be authorized to deduct CGT at source. Example, Bode makes 15 million naira gain in 2026. After deducting expenses, its taxable gain is 10 million naira. It must file by March 31st, 2027. Late filing equals penalties plus interest. Why this matters? Compliance saves money. Filing is now part of the investing process, like updating your watch list. Final takeaway, the new CGT system rewards organized long-term and reinvestment-focused investors, with exemptions for small traders, startup investors, PFAs, and anyone reinvesting gains. Most everyday investors will pay little or nothing. Now is the time to 1. Review your portfolio before December 31st, 2025. 2. Understand where you fall, exempt, small trader, institutional, etc. 3. Track your buys, sales, fees, and losses. 4. Use reinvestment relief to avoid unnecessary tax. 5. Ask questions early. Don't wait until filing time. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 070-8246-3747. Stay blessed and have a great week.